Good evening, everyone. Patrick Casey is my name. I'm the chairperson of the Chartered Accountants Midwest Society, and I'm delighted to welcome you here this evening to our webinar on practical considerations and value in a company with Brian Hawk. Brian is the head of valuations and financial modelling in BDO Ireland and is a lead member of their healthcare consulting team since joining the firm in 2012. Brian has led numerous valuation assignments across various sectors, in particular healthcare and infrastructural asset management projects. In his role, he has advised a variety of clients in assessing values of unquoted companies, intellectual property, and unincorporated businesses. Brian is experienced in the preparation of valuations for restructuring, fundraising, and M&A purposes. So without further ado, I'm delighted to welcome Brian Hawk for this webinar tonight. Brian has mentioned, which I'll probably say to you anyways, if you've Q&As, questions and answers, he might try and get through them as we go along. So there's a Q&A box down the bottom. So if you could put your questions in there and we'll try and get through them as we go along, if not at the end. So without further ado, I'll hand over to Brian. Thanks, Brian.
Thanks, Patrick. Thanks for that introduction. You forgot my my greatest achievement was that I had Patrick Casey as a trainee during his time at BDO many years ago, and he went on to do great things.
Top class. Thank you, Brian.
So thanks very much to Patrick and Kathy and Chartered Accountants Midwest Society for having me today. I'm very happy to have the opportunity to chat with you all. The topic this evening is practical considerations in valuing companies, and what we'll, as the name suggests, I'm going to try to keep it on the more practical aspects and try not to delve too deep into the weeds on things like weighted average cost of capital, alphas, betas, those kinds of things. We try to keep it practical and talk about the things that come up as we're doing valuation assignments, and share a bit of my experience and what and that may be helpful to you if you're carrying out a valuation assignment. As Patrick said, I'd like to, if I can, deal with questions as we go along. So what I'll do is I've my presentation broken into 4 sections, and what I'll try to do is, if you want to pop any questions you have into the Q&A box, I'll try to deal with it as we go along. If there's something that needs a long answer or is particularly technical, I might try to deal with that afterwards. Maybe I can follow up with an email to you. So just to introduce myself, as Patrick said, I head up the valuation and financial modelling services at BDO. I joined BDO in 2012, and the areas I've worked in are public sector advisory, healthcare, and the particular specialty that I've developed over my time is in the area of financial modelling and valuations. And in BDO, we established in our Limerick office a Valuation and Financial Modelling Centre of Excellence, where we've gathered some of our best people in the area into one team to try to drive the standard of service that that we're providing to clients, to try to drive it and raise the bar, and I guess try to push ourselves to provide to get that better level of service. We're focused, my team is focused exclusively on valuation and financial modeling and the related things like that. Our team don't do tax or audit, so we often work with audit firms or tax firms who have clients that have valuation requirements, and I wouldn't be able to take your tax or audit clients off of you, so you'd have no worry about that. So that's as Patrick said, the areas we do. I guess because we are situated within a corporate finance team, we do a lot of work in relation to M&A and preparing companies for sale. But we also do things for we also do valuations for financial reporting. IAS valuations are for tax purposes. We've also done quite a bit of dispute resolution where litigation cases where you have shareholders where there might be a minority interest dispute or minority suppression or something like that, and there's a dispute over what the valuation is. So as I said, I've split today's webinar into 4 sections. One is the introduction to the valuation basics, which as the name sounds, it is the basics, but there are some interesting practical considerations that is worth going into. Pre-engagement considerations. A lot of the important things that you have to consider in a valuation is they take place actually before you even take on the engagement. And so I'll discuss some of those and some of the interesting questions that we have to deal with. And then we'll deal with valuation, the various valuation approaches, with the main income approach and market approach and whatnot. And then I'll deal with some of the impacts we've seen in relation to COVID and how that has maybe impacted on valuations that we've been doing. So I guess I'm going to take it right back to really fundamentals, because I think it's important when we talk about it to say, what is a business valuation? Because I find when people are discussing it, the idea of what the value is or what their value is, it may not actually be rooted in what a business valuation and what a business valuation is. People think about the time they've put into a business or the emotional investment they have in a business, and all of those things are they are important to the person who has put them into the business, but they don't really matter to someone out in the market. So a business valuation, what we seek to do is we're seeking to estimate the price that you might achieve for a particular business unit or cash flow if you brought it out to the market. So that not we don't just value companies. I mean, you value a whole company. You might be just valuing a part of a company, or maybe just making a value of an investment for an investment appraisal. Then the ultimate goal of carrying out a valuation assignment is to try to figure out what somebody in the market would pay. And other than trophy assets, the reason that somebody will pay you money for an asset is that they expect to get some kind of future cash flow from that asset. I was reading an interesting thing there today where it was just calling out that difference between investing and trading, where if you're investing, you're expecting to get a future income stream, whereas trading, in commodities, say, there is no future income stream other than when you sell it. So you're expecting the price to go up and down, but the value is really just inherent. It is only a price. It's not a value in a future income stream. And then how do we go about figuring out what a purchaser might pay us for the future cash flows? So the purchaser, it's valuation theory that a purchaser will pay a higher price for a future cash flow if there's a greater level of certainty. So I mean, if you know that you can get a 1 million euro per year return, what will you pay for that? You'll pay a lot more if you know that there's 100% certainty that you're going to get your 1 million than if you think there's only a 50-50 chance of getting your 100 or your 1 million per year. So that comes into it, and it's how do we price that risk? And the starting point always is the risk-free rate of return. So the risk-free rate of return is, we try to estimate that by saying, well, what are government bonds trading at? So a government bond at the moment is almost down near zero, and in some cases, it's just extremely, it's historically low at the moment, and it is almost at no rate of return. But the theory is that the price of any given cash flow will be determined by how risky it is compared to that risk-free rate of return. So it's your risk premium over that risk-free rate. And I mentioned price versus valuation there earlier, and there's often people think that they're the same thing, but really they're not. The price is the consideration for an actual transaction, and that's a matter of fact, because you can point to it. Somebody will have said that they have, that they'll pay €1 million for a business, and they would pay the €1 million for the business, and that's a price, and that's there's no debate over what that is, but that may not actually reflect the true value. It's impacted by supply and demand. For example, if you've heard of buyers markets and sellers markets, if you've an oversupply of a certain asset, even though the risk profile might not change, the price you might achieve on the market just by virtue of the fact that there's a lot of sellers with that same product. And then if you don't have enough buyers out there, so if you would have seen that a lot during the financial crisis, where a lot of businesses and property assets traded for what you would believe is below value, because there was a lack of people out there with that had the cash to transact. And valuation then is actually, it's a notional estimation of the price that you might get if you put it on the market. And you say, well, what, isn't that the same thing? You're just looking for the price, but it's what you're trying to do there is say, well, it is a theoretical exercise. It's an opinion. Evaluation is always an opinion, and there's a significant amount of subjectivity that goes into it. And as we said about the price, it may not always reflect the actual price that you'll get, but what you're trying to do is you're trying to give your best estimate of what somebody might do, or what somebody might get out on the market. And I guess probably the best way to think about, well, why are value and price not the same thing? The underpinning theory behind most people buying an investment is that they think it's going to be that it's undervalued and it'll increase in value in the future, in trading. So if value and price were the same thing, then there'd be no money to be made in the stock market. One of when you're approaching a valuation assignment, there tend to be two extremes in the way people approach it. One being the numbers and one being the narrative approach. And the numbers approach tends to be very technical, where you say, well, these are the inputs. We have the CAPM model, and we know what alpha is, and we know what beta is, and we know what the equity risk premium is. And so we just put all of them into a formula, and then boom, out the other side, you get your value. And so there's the trouble with that is that there's there's a real tendency to just have an overconfidence in it, because you say, well, that's a mathematical formula, and it's underpinned by solid financial theory, and so it's right. But there's a great deal of subjectivity that goes into choosing any of those a lot of those inputs, not all of them. And if you don't choose them correctly, you end up with a formula that just doesn't work. So if you're excessively reliant on on a numbers approach, and you don't contextualize it in the real world and contextualize it in a narrative about what the business's prospects are into the future, you have a real danger of not of coming out with a wrong answer. And I give an example of it, and it's an internal one that happened in my team, where somebody came to me and they said, well, I've done the cash flow and I've done my research and I got the equity risk premium, and this is what alpha is and this is what beta is, and I've discounted the cash flow, and so here's the valuation. And when we looked at it, it was 23 times EBITDA. Now, that's what you'd expect a Facebook or a Google to trade at, or some kind of tech firm. It's not what you'd expect a small food processor based in Ireland with a regional reach to trade at. So, you know, it just shows, you know, you really need to step back and think about it. The narrative based approach then is, you know, it's one that's easy to get caught up in, because a good story is very powerful. But you know, there's a real, I guess the types of those I mean, we've probably all met an entrepreneur that really has a compelling story about their business and why it's going to be world changing and why everybody's going to need it. But if you can't back that up with numbers, there's a real danger that you just get swept away, and you're not limited then, or grounded in reality. So really what you want is, you want somewhere in between. You want to be rooted in somewhere that combines narrative with numbers. And I think that if anybody wants the slide, I think we can share these afterwards. So I won't go into this with too much detail, but you know, the steps that we like to take are: develop a narrative, test the narrative against history, you know, have other companies lived this story? Does the past performance of this company suggest that they can do what they say they're going to do in the future? You know, are there gaps in that? And then convert the narrative into value drivers. So, you know, what are the things that are going to, what are the fundamentals that they need to achieve? Like, do they need to, is it a tech company that needs users? Is it, you know, is it a company that needs to move from the Irish market into the UK market to achieve a certain level of growth? You connect those value drivers and build your valuation model, whatever approach you might be using, and then build that out and scenario test to make sure that it makes sense. So, you know, does it make sense? You say, well, if we increase sales by 10%, if we decrease sales by 10%, what does that tell us? And then always worth keeping that feedback loop open. I mean, even though it's an evaluation exercise and is an independent opinion, it's always important to be willing to listen to the owners and your client, because ultimately they know that business a whole lot better than you do. So it'll be quite arrogant to say, well, you know, I've gone off into a cave and I've done my calculations and here's the answer, and I'm not taking any feedback on that. There very often are things that when you've done that calculation, they say, oh, well, you actually misunderstood that about the business. And you know, that happens, and it's worth making it a slightly iterative process, as long as you're resistant to showing them what the value drivers are, so that they can tell you a different story about them. You know, you do need to be careful about that. So, you know, even just approaching an evaluation assignment, you know, you do have to be careful about how you approach it, and not to tend too far to one way or the other. So then these are certain pre-engagement considerations that I think are very important. And a lot of, you know, there's an awful lot that has to be considered before you take on an assignment. And these are real kind of, I won't say boring things, but they're the real kind of your standard stuff, like defining who the client and who the intended users are. I mean, you might think that'd be obvious, but is the client the company itself, or is it one of the shareholders? Is it a minority shareholder, a majority shareholder? You know, are the intended, is it a shareholder that wants a valuation because they want to use that to go and market the shares? And you know, one of our limitations in our audit, or in our evaluation opinion, is always that it can't be used in a prospectus or something like that. So, you know, you need to make sure that that's clear, that somebody doesn't expect that they'll take your valuation and put it into a brochure to say that BDO, or like in my case, BDO said that the valuation is 10 million. A couple of other things there. The valuation date is very important. I mean, is it today's date, or are you valuing it at some point in the past? Often in disputes, we've had to do valuations dated a couple of years previously, and one of the difficulties that gives rise to is that things have happened since then. So you would be looking at financial projections if say for that were prepared in December 2018 for the years 2019, 2020, and 2021. And, you know, with the benefit of hindsight, we know that things didn't turn out the way anybody thought they would in December 2018. But you really have to put that aside, because your valuation date is what would somebody have paid at that valuation date. Then the purpose of the engagement. I mean, is it for inclusion in financial statements, or is it for a tax valuation? Because the revenue has certain guidance around certain aspects of valuation that you need to make sure you take into consideration. I'll get on to standards and basis of value in a minute. But other considerations, like, you always have to ask ourselves, do we have the required expertise to value the things in this company? If it's a tech company, does it have IP to be valued? And if so, I mean, I'm not an IP expert. There are ways you can value. I do know of ways that I can value IP, but I need to be comfortable that the IP in question can be valued that way, and that I don't need to get an outside expert to come in and do that part of the valuation. Property is another thing. If there's a property on the balance sheet that maybe is not being used as an investment property, you may need to get a property expert in to look at that. So those are some of the kind of the interesting things that even before you do up an engagement letter that you need to wrestle with. Then the premise of value. I mean, there's you know, you need to decide, is it going to be a going concern, current use? That's the most common way that you'd be approaching evaluation, is that it's going to continue as it is. Or is it highest and best use? I mean, if you have a company that is maybe a small company that's working out of a warehouse, doesn't have a huge not doing any, that doesn't have any great turnover, the current use of that, where it's not generating a lot of cash flows, might not be very much, but it might own its warehouse. And so the breakup value or highest might be better than the current use value. So you need to you need to think about that. And then a breakup valuation, whether it's an orderly liquidation or a forced liquidation, would certainly impact. I mean, I many years ago worked in insolvency, and I certainly saw that when a company went into liquidation, debtors almost became unrecoverable in a lot of cases, compared to if you continue trading it. Your plant and machinery, you know, if you can't find a similar business that wants to buy them, it's very difficult to realize that value. So those are considerations that you need to look at. But as I said, going concern is going to be the most common. But highest and best use is likely something that you're going to have to think about, especially if you're dealing with a valuation dispute between shareholders, because one of them may be saying, well, we could get more value out of the business run a different way, and you do have to consider that. I think this graphic then is actually a really useful graphic for demonstrating what different you know, the different perspectives on value. Let me just see if I can get a laser pointer. Is that? Oh, no, didn't work. So I don't have a laser pointer, so hopefully you'll be able to follow what I'm saying. So if we start with just that gray box there, the standalone business, that's the business as it is today is the value to an owner, its current owner. So it's generating a certain amount of cash flow today. It's likely to continue or to generate a certain amount of cash flow into the future. The owner has the current owner is able to finance it with whatever mix of debt and equity they have access to, and so that value represents what the current owner has access to. The market value, you see the arrow there beside it, market value / fair value per IFRS 13. That is showing that there may be additional value there that a market participant may see. So that's saying that if you, and it's likely to, or if there isn't a market participant synergistic value, then it's unlikely you're going to find a buyer out in the market, because the owner is unlikely to sell it for more than its investment value to themselves, unless they're looking to retire or something like that. So if they're going to sell it, they're going to be looking for to realize more than it's worth for them to keep it, and you're going to be looking for what somebody out in the market, what another buyer might be able to do with it. Maybe they have access to different markets. Maybe they have access to a different capital structure that can help them to fund growth. So that may be large or it may be small. And then you see outside that, you have another synergistic value, which shows that investment value to buyer. And what that's trying to show there is that you may have the market participant synergistic value may be different from the buyer's synergistic value. So you might have one particular buyer, and that particular buyer may be willing to pay a price much higher than anyone else in the market, because they can get a synergy from the business which is higher than anyone else. Maybe it's particularly strategically important to them and to their type of business. So hopefully that makes sense. If anybody has any questions, please do pop them into the question and answers box there. But I guess what's important here is to, it's that view that if you're looking for market value, it's not, you don't take into account that there might be one purchaser out there that will pay you a lot of money for it. Because I have come across that where someone says, well, I know this person will pay 10 million because for our company because they various reasons, and you say, well, that's great, but there's 8 other people out there in the market that wouldn't pay you more than 5 million for it because they can't get the same value, they can't extract the same value out of it. So I think it's a really useful graphic, but it is important to think about that, because we don't always get asked we don't always get asked to value the market value. Sometimes we're asked for other valuations here, where they're saying, for example, what's the investment value to buyer? And that's particularly important if you're looking at an M&A transaction. It's not necessarily, you're looking and saying, well, what does that investment cash flow look like to them? And you're not saying necessarily that this is the market value. You might be saying, well, if that investor buys into the story and the narrative, then this is what can be achieved, and this is the value that can be extracted out into the future.
Ryan, there was just a question in there from Geraldine Pierce. Is there any way to estimate the synergistic value?
So, well, so the synergistic value, I presume, is this green one we're talking about here.
I would, yeah.
And is that all right? So that's gone into chat rather than the Q&A. Sorry, I had the wrong box open there. So really what you'd have to do is adopt the perspective of that particular purchaser and say ultimately what we're looking at here is the future cash flows. So the investment value to owner here is what cash flows we think the investor can, the current owner can generate by themselves. The market participant synergistic value is what we think, your average market participant that doesn't have a particular synergistic value here in this, what your average market participant would be able to generate. So it's assuming that somebody else will come along, that the average market participant will come along and generate additional cash flows over what the current owner could do. And then that green line there is saying, well, if we take the perspective of that single buyer, what additional cash flows do we think that they could generate out of it? And that might sound a bit vague, but you really do have to, it does come down to the specifics of the situation. And what you really have to do is put yourselves in the shoes of that particular buyer. But that's, that is very important in an M&A transaction where you may be targeting and saying, who should we target to sell this company to? So hopefully that covered it. Next consideration are levels of value. So this is particularly important. This is important not only when you're trying to consider minority interests, but also when you're trying to compare the, say, market data to your subject company. And the theory here is that you have control level value, non-controlling marketable value, and then non-controlling non-marketable value. And the control level value essentially is that you can control the company, you can control what all the business decisions. If you have 100% control, 100% shareholding, you have control level value, and you have a marketable interest because you can sell those. If you have a non-controlling marketable level, that means that you can't. You would have less than 50%. You wouldn't be able to force a vote, but you still have enough of an interest that you can sell it, or your interest is liquid enough that you can sell it. So a non-controlling marketable level interest would be very low for a public company on the stock exchange, but it would be much higher for a private company. And then a non-controlling, non-marketable interest would be if you had a 10% interest in a family company, or sorry, not a family company, but because you might have control through other members of your family, but say not a 10% interest in a company where somebody else has a 90% stake. I mean, there's not a lot of people that are going to come along and buy that 10% stake because you can't control really anything that goes on in the company. You're just sitting there as a passive shareholder. So there's the concept of discounts for lack of control or discounts for lack of marketability, or the inverse being that you might pay a control premium if you're buying a shareholding that will give you control of the company. And there's a lot of different data out there that estimates these discounts being between 10 and 60%. So it's very difficult to be specific and say that a discount for lack of control or discount for lack of marketability is any particular percentage. But if you were doing a revenue valuation, they do provide some guidance as to say 10 to 15% of a shareholding is X% of a discount. So I mean that's a useful guide. You really have to exercise your judgment in it. But that's very important. Where it's also important, actually no, I'll deal with it when we're dealing with the market approach. Move on. So the valuation approaches then. So there's three main approaches to valuing companies. Now I know there are a lot of other ways that you can value investments or companies, like dividend discount models, or relief from royalty method. But these are the main ones. The income approach, where you're assessing the future cash flows. You're directly looking at the future cash flows of the company, and generally you'll be taking a discounted cash flow approach, using the time value of money to estimate what somebody will pay today. You've the market approach. So with the market approach, what you're doing is you're saying, is there a similar company out there that has publicly available information on its value that I can use as a benchmark to value the company I'm looking at? And so, you might look at the stock exchange and say that there's companies that are trading at whatever multiple of sales or EBITDA or whatever the appropriate is for that particular sector. The other one is Guideline Transactions. So, if there have been actual transactions, they're sometimes better than guideline public companies, because their prices, it shows you what actual transactions are happening and what people are actually paying for things, rather than while the stock exchange is what prices people are paying for shares, it's not for the whole company, and there are differences there. In particular, so it's going back to the control premium. If you the price implied by the stock market is a non-controlling price, so you have to adjust for that to get to your subject company valuation. But then there's problems where the public companies are likely to trade for higher multiples than private companies. So it can be quite difficult, unless you have a very large company, to use publicly traded multiples. The cost or asset approach then is it's a less commonly used one, but it's worth considering. That'll be the approach you'd be looking at if it was a breakup basis. But it's also, you may need to look at the assets in combination with the others. If you have maybe a non-core asset on the balance sheet that is not actually contributing to cash flow, and so is actually in addition to the enterprise value. Another reason you might do it is if you have an early stage company, you might say, well, what would somebody pay what would it cost someone to put this company into existence if they were to, what would they pay to not have to invest all that money to get a company to this point? So the income approach, just briefly, as I said, we won't get into the nitty gritty of this, but what you're looking at here is you're trying to look at the future cash flows and then discount them based on the time value of money. So there's two main cash flows that you'd look at, is the free cash flow to the firm, which is usually EBITDA, or the free cash flow to equity, which is after you've paid all your tax and debt and everything, it's what can actually flow out to equity. And so if you're looking at free cash flow to firm, it's your weighted average cost of capital, and with the formula there. So, taking into account how much debt, how much equity you have, what the cost of debt is, what the cost of equity is, your tax rates, all of those kinds of things. Whereas cost of equity, or if you're looking at the equity cash flow, you're really only interested in the cost of equity. Although it can be a job calculating the cost of equity. So very briefly, the approach in discounted cash flow, you have to estimate the cash flow over a projection period, estimate the you want to do that for a certain period of time. You want to do, so one of the things when you're looking out at these projections is you want to do the projections for long enough that you get stabilization of the company's growth or whatever trend they're on at the moment. But you don't want to go too far out, really, because at a certain point you're just crystal ball gazing. I mean, if you can accurately project a company's performance in 10 years time, please let me know, because There's lots of people who pay you a lot of money for that. But so, I mean, generally you're projecting out 3 to 5 years, but you're looking for stabilization. So if the company is growing at the moment, you're saying, well, it's going to experience high growth for a couple of years and then it's going to level off, because a company can't grow by 10% per annum into perpetuity, quite simply because it would eventually become bigger than the world economy, because the world economy is only grown by a certain rate. So into perpetuity, it doesn't make sense if you have these really high growth rates. So you want to bring it to a certain point, and then you get to stabilization. And once you get to stabilization, you can apply a terminal value calculation, whether it be the Gordon growth or whatever. And then when you have your projected cash flow and you've your terminal cash flow, you need to discount it back. Some of the practical issues that we have, that we come across when we're doing this is, well, what if the company doesn't have projections? You do get companies that they've great businesses, but they don't have projections, or their projections are unsophisticated. So, I mean, you're an independent, trying to provide an independent valuation opinion, so it probably shouldn't be preparing projections, but in some cases you have to do your best and just note that you have done these, and that you've just make sure that management confirm all of the assumptions that you've made, and that you're not making up your own assumptions. That if you're doing the calculations, make sure all the assumptions have come from management, have been confirmed by management, and note in your report that management have confirmed this. Other things are what if you've unduly optimistic or pessimistic projections? I mean, most people would be familiar with the unduly optimistic, where everybody thinks that their business is brilliant and is going to do really well. But you can also get unduly pessimistic, where if you have a shareholder dispute, you have one shareholder that says, well, I'm going to buy you out for this price because the prospects are actually really bad, so I'm only going to pay you this amount. And you got to kind of take your view on that and say, do they look realistic? It may be that you have to recast the projections, and I would say you shouldn't throw out the projections you've been given from management, but maybe you need to recast and deal with a range there based on, you say, well, look, this is management's case, and then there might be an upside case to that, and that a market participant might look at. And then other things that we have to consider is what are the practical things that this company has to do to achieve its projections? I mean, does it have to get a 90% market share? Does it have to double the price it's charging for its for its products? And what kind of level of customer growth does it need? Like these are practical questions that you really have to interrogate in the financial projections. And I mentioned what's the a dispute around minority oppression. I think you just have to step back and do your best. There's no right answer there really, but ultimately, if someone's coming to you, they're relying on your expert opinion, and you have to have confidence in your expertise that you can assess those things. Or if you don't have confidence, you need to be able to step back and say, sorry, I don't understand the business enough, and I don't understand those I don't understand the business well enough to make an informed view on that. Practical issues around calculating WACC. I mean, I spoke earlier about the overconfidence that can come with WACC, and in that case, we had it was using the cost of equity for a publicly traded company and assuming that that's the same for a private company. I mean, like my example there is, the cost of equity for Nike is not the same as the cost of equity for O'Neill's, most likely. It's not the same as the cost of equity for Gym Plus Coffee. because those are, although they're all clothing brands, they're all sportswear, leisurewear brands, they're very, very different companies in terms of market diversification, the diversification of sports they're looking at in terms of the size. So there really is a big difference there. So you really have to dig into that. One of the things that I think about there, a lot of companies that you might be asked to value would be private companies operating just in Ireland. And one of the things that I think about is, well, is this likely to be a private equity play? And a lot of companies, in that kind of mid-tier kind of space, it is likely any equity that comes in is likely to be a private equity play. And private equity tends to want to double its money in 3 to 5 years. And so that means your cost of equity isn't likely to be less than 18%. So if you're going out and looking at Nike's cost of equity and saying that that's 8%, and then you're just plugging that into a model, you're not going to get the right answer. So the specific risk premia, have you sufficiently captured the difference? I mean, that's your alphas. I mean, do you have a country? Do you have a sector risk premium? Do you have a small capitalization risk premium because it's a small company? Is there are management very bad at running the company? Do you need to put a risk premium in for that? That's where you need to capture those things. But there's a significant element of judgment there, and for example, if you take that example of if you're putting in a discount for management not being able to run the company very well, you better be able to justify that. Then your gearing ratio for WACC. I mean, you can get, there's excellent, there's sources where you can find, what the average gearing in a particular sector is. And I've some of those sources there, where are you getting your inputs from? Damadran. So that's NYU Stern's Answer Damadran. He's does some really excellent free information. Now, his website's really clunky, and you're downloading spreadsheets and trying to interpret them, but it's just an absolute gem of a resource for free information. Duff and Phelps Cost of Capital Navigator is a paid resource, but it's also very good. There's sentiment surveys and private equity reports. I mean, private equity reports are very useful if you're doing a valuation for a company that's going for M&A, because you may discover that, like we did in one particular sector, that private equity is targeting 30% return on 30% IRRs, which is is pretty significant. Sorry, just have a question there. We'll have to look at if you're valuing a company based on EBITDA and the company has substantial historic losses and the losses have a corporation tax benefit, how would this be factored into the valuation? So that's getting into the technical a little bit, but because the tax shelter of things like interest and historical losses tend to be dealt with through the tax shelter would come into the cash flow to equity rather than the enterprise value to the company. But what you would be looking at is sorry, take it back a step. So if you're looking at EBITDA, you'd be looking at trying to calculate an effective tax rate to get to the free cash flow to the company. And if you use that effective tax rate when you're projecting out. So if you have tax shelter of losses, then when you're forecasting out the free cash flow, you're going to not have a tax charge for those couple of years. But I would say you absolutely have to forecast past where all of those tax losses have been utilized. but yeah, that's without I guess, doing a worked example, it's difficult to fully get into that. But if my contact details are at the end, so if you want to contact me, I can we can chat afterwards, and I'll take you through a worked example on it. The market approach that's the multiple approach. The famous multiple approach is the multiple approach is a market approach. It's not the only market approach, but it is the main one. And as I alluded to there earlier, there's the main methods for those are the guideline company method, the guideline transaction method, or the recent transaction method. So the guideline company method, there's a lot of great data out there on that, but is it really comparable to the company that you're valuing? Guideline transactions, you're looking at information that you have, so where a similar company would have sold recently, and so merger market or capital IQ are good sources for those. But again, the assumption embedded in a multiple-based valuation is that the fundamentals are, so in terms of growth, profit margins, etc., that they are the same for the comparable company to the company you're looking at. So if they're not, then that multiple isn't really comparable. And in particular, in private transactions, you could have add backs, the growth prospects could be different. And sometimes there just isn't enough information available publicly for you to draw those conclusions about multiples. And the other thing about the transactions is, with public companies, at least they publish their forecasts for the next few years, and that's what people base the valuations on. And so the multiple is based on those expectations of future cash flows. With private transactions, there's an expectation of future cash flows, but you don't know what the growth rate is. You can see what last year's, hopefully you might be able to see what last year's EBITDA is, but you don't know what kind of growth rate they're forecasting into the future. I mean, they could be 20% year on year for a couple of years, and your company might only have 10%. So there are real drawbacks to these, but it is always useful as a sense check. If your discounted cash flow is showing that your company should be trading at a 10x multiple, and then all the transactions are at 5x, then you have to be asking questions and say, you have to ask yourself some deep questions and say, are you considering everything? Are all of your assumptions correct? Is there something that you have missed when you're doing your discounted cash flow? And I would always recommend doing both discounted cash flow and a market valuation. And some people would just take the two of them and get the average. I don't think that's necessarily the right way to do. I prefer to lean on discounted cash flow and then use the market-based, multiple-based cash flow, or sorry, multiple-based valuation as a sense check for that discounted cash flow. After skipping on there by accident. So then just the asset approach. I mean, one of the real practical considerations that you have to get into in relation to assets is, do you need expert opinion? Like, are there properties, are there intangibles that need to be valued? But one of the places that you're likely to do an asset approach is if you're doing a purchase price allocation for a transaction. You're going to have to go in and you might have to value intangibles like the workforce or customer book or order books or things like that. With those, you're likely to be able to figure those out. But if there's IP in there, you may need to get someone else in. If there's a property that, say, is sitting at cost price where it was bought in 2005, what's that worth now? You may also need to, if you're looking at debt, if somebody has debt in at a fixed rate and the market rates have moved significantly, the market value of that debt is not necessarily the book value. So you have to make an adjustment for the difference between to get what the fair value of that debt is. So then, what's the impact? What has been the impact of COVID? One of the impacts of COVID is that it's made me almost lose faith in financial information. I mean, we went going through a time of one of the most globally uncertain times that we've had, and for many, the stock market is still in a bull market. Probably driven more by monetary stimulus than any fundamentals. So I'm especially cautious of multiple based valuations at the moment, because I think that asset prices have been pushed up by monetary policy. It's very difficult to. I'm not the only one that thinks this. I mean, it's Damadran from NYU Stern. He actually one thing I would recommend everybody do is to sign up for his newsletter, which very conveniently also comes as a YouTube video, so you don't have to read it. He'll read it to you. But he does some really fascinating analysis, and he was looking at the current risk-free rates and equity risk premiums and what that looked like versus historical trends. And his analysis said that we probably were in an overvalued S&P 500. So, but the flip side of that is if you're selling now, cost of funds is low, so you're probably going to sell based on those higher valuations. So it's a tricky one. You really have to be cautious. You kind of have to be cautious about where what's the valuation going to be used for. There's particular questions around discounted cash flow. We've historically low risk-free rates of return, which is counterintuitive when you consider the huge increase in risk you would think due to COVID. I mean, business risk, also you would say has gone up, but despite the equity risk premium fluctuating a bit last year, it's kind of now at pre-crisis levels, and you'd say we're nowhere near the same level of business risk overall now as we would have been 18 months ago. So it's a bit it's a bit of a head scratcher in terms of that. But I guess people have come to terms with the level of risk out there, and they're happy-ish with it. One thing that we were I would say really watch out for is that if you're looking at beta in your CAPM model, looking backwards a long way is not necessarily the best way to find beta. So beta is, that's going to tell you how much how much the stock is going to move with the market or not. So how correlated to market movements it is. So with 1 being perfectly correlated and 0 being not correlated at all, that'll move completely on not with it. And for example, we were valuing a class of asset, an investment asset, and we had a basket of similar assets that we were using to kind of assess what beta might be for this. And when COVID came along, what we noticed is that the betas for some parts of that basket of assets went one way, and the betas for the other went the other. And it was because some were healthcare assets and some weren't. And healthcare assets did not move with the market in the same way as they would have previously, because of the type of crisis we're in now, and because healthcare assets have performed much better over the crisis than other what would have previously been seen as similar assets. So definitely try to get as up-to-date information you can on beta. May need additional specific risk premia if the sector risks have increased by COVID. Now, that's not the same as that the sector is particularly badly impacted by COVID. That's to say that it's that it's now a riskier proposition, that COVID has revealed that it's a riskier proposition. And one of those things is, there's great debate out there at the moment about whether office space has the same risk profile as it previously had. Is blue chip office still blue chip? I know that's not company valuation, but it's still, you're still valuing cash flows. So that, I would say, your specific risk premium is different there than it previously would have been. Whereas, say, hospitality, has that been fundamentally changed by COVID? It's certainly been very badly impacted, but I don't know in the long term if it's been fundamentally changed, where there's additional risks above. It was always seasonal. It was always subject to to shocks like this. I would argue that the risk premium associated with that, I would argue that you wouldn't necessarily have one. But in general, I would be saying that if you're doing a discounted cash flow, you really don't want to be trying to factor for COVID in your WACC. Really, what should be looking is, you would look for the client or management, that they need to be updating their cash flows to take into account COVID, and they need to be doing scenario testing to say, well, what's our best case scenario and what's our worst case scenario, and then you then have a good data set that you can do a discounted cash flow on, and you can make a better opinion, because, like, as I said before, they know their business better than you do. So you trying to detail the complexity of COVID and how it might impact on their business by changing alpha to me, it's not where you should be doing it. You should be working with them and saying, look, we need to get a really good handle of where your cash flows might go into the future. So, I mean, my key takeaways that I hope you get from today are that you're trying to pay, what you're trying to do is determine what a purchaser would pay for a business interest or a business unit or a cash flow. And this is, it's determined by the expectation of future benefits and the risks of those. So it's, you have a cash generating unit, you have future cash flows, and you have the risk of those. And that's really what you're trying to assess. Everything else is just noise, really. That's what you're trying to assess, is what's the risk of those future cash flows, and how much does somebody pay me for based on those risks. So really important to define the engagement at the outset. Really important to all of those things I said, like what's the basis, what's the premise, what's the what level of value are you looking at, balancing your numbers versus narrative. It's very easy to veer off one way or another, or get overconfident in a narrative or overconfident in the numbers. You really need to be constantly sense checking what you're doing and saying, like, what, on the one hand, valuation is a very technical exercise, where you're doing a lot of very complex maths, and you can get really lost in the theory of it. But ultimately, you do have to ground that in reality, and there's a lot of subjective judgment that goes into it, and experience is key. And everybody on this call has experience in business. They've seen, they're either advising clients or they're working in businesses. Bring that experience to bear when you do that sense check, when you do that gut check, because ultimately that's what we're being paid for, is to exercise that subjective judgment and bring that expertise that we've amassed over the years of advising businesses, to bring that to the table. So that's where we as chartered accountants are adding the value. So don't forget that. That's really important. So thanks very much. Only had 2 questions. I don't know if anyone has any other questions that they want to pop in there. I know I'm after running over the hour and everybody probably wants to go home and have their dinner. But I have my email is there if anybody wants to shoot me a question afterwards. So look, thank you, and thank you Chartered Accountants Midwest for having me, and hopefully everyone will have gotten some benefit out of that, and hopefully we didn't lose too many participants over the over the hour.
Absolutely, Brian. Thank you very much. That was fantastic. Very, very interesting. And I suppose I would encourage everybody here, if they do have any questions, there's a fantastic team in BDO Limerick, and Brian's details are there. So if there are any technical issues or anything, the guys there will be more than happy to come back to you on. Just a couple of things to wrap up. Our next couple of events are, we have a cook along with Owen Sheehan on the 29th of April, so it'll be a bit lighthearted. You don't have to cook, you can just watch if you want, and that'll be in Kathy's latest email. Our AGM is on the 19th of May, so that's another date for the diary. And I suppose one other thing, Chartered Accountants Midwest Society member Pat Rickard is going for council elections, so I would encourage everybody to use their vote where possible. The vote was open for, I think, another week. So you would have all got an email for that. And I think that's it. I suppose my final word will go to Brian, and thank you very much. That has been an absolutely fantastic session, and very much appreciated from all in Chartered Accountants Midwest Society.
Thanks, Patrick.
See you later, guys. Thanks.
All the best.